Good afternoon. Welcome to the FinLink FinCast, where we're going to talk about everything wealth management, particularly as it relates to M&A. I'm very happy to have James Hughes from Live Oak Bank with us today, where we're going to be discussing a range of topics from the lending perspective. Welcome, James.
Thanks for having me, Xander.
Of course. Just a little bio on James. James is the managing director and head of professional services at Live Oak Bank. In his role, James is the head of investment advisory lending and oversees the management of insurance, accounting and tax, and law practice lending. Since joining Live Oak in 2013, he has helped hundreds of businesses achieve their goals through financing. And forgive me if I'm wrong, but I think you had your biggest year last year, correct?
That's right. Yeah.
No. Well, to begin the conversation, I'm sure most of our audience has heard about Live Oak, but historically, the bank has been known as a SBA shop. I know that's not the case now with your team. Can you give us a little history on the bank and what you guys are doing outside of SBA and what's differentiating you in the market today?
Yeah. So we still do a lot of SBA lending, still largest SBA lender by dollar volume. And I think what we've done in wealth management is really aligned with what the bank's doing as a whole. So we are still doing a lot of SBA lending across all industries. But in the wealth management space, we've really moved more to conventional lending. Last year, we did 90% of what we did in loans was conventional and 10% was SBA. Really, I think we just kind of grew with the industry. So when we started lending in 2013, we were almost solely doing SBA loans. And, I mean, that's really what the market was asking for. And I think as we get into this conversation, it'll sort of align well with the broader conversation about what's going on in the market. But the independent wealth management industry has changed significantly since 2013 when we started. And it was during COVID and the market correction in 2020 that really caused us to change gears in the wealth management group. Um, Markets were off, nearly 40%, and we had these meetings with our president and CEO talking about all of our portfolios. When we got in the room and talked about the wealth management portfolio, there was really nothing negative to say. We were asked to talk about our largest credits, our largest concerns, and we didn't have really any concerns. And our largest customers had a lot of liquidity, and AUM was not off, 40%. Turns out financial advisors know how to allocate assets. Um, and so if that was, one of the events we were most scared of in lending to financial advisors and our portfolio was mainly SBA, the directive we got from our president and CEO was to go out and take more risk and to look for larger opportunities, start to try and build out like a lower middle market type portfolio. And, that's exactly what we did. And so, probably 3 years ago in 2022, we brought on our largest customer we have to date. Prior to that, we did some sort of middle-sized deals, 10, $15 million. But it was in 2022 that we really sort of brought on these larger conventional customers. And happy to say, like you said, last year was our best year. We've got some really nice customers in the portfolio. And I think that'll continue to be the directive we have here, is to look for larger customers and put together larger credit facilities for these firms.
What do those credit facilities look like? And what would that look like compared to your run of the mill $1 million loan, say, as opposed to a $20 million facility?
Yeah, and I mean, to be clear, like we still, like I said, Live Oak still does a lot of SBA lending. across all its industries. And within wealth management, we'll still do an SBA loan, and we've got a small loan desk that does anywhere from $10,000 to $500,000 very quickly. And so that's been very the market has received that well. So that's a very busy desk for us right now with advisors.
Yeah,
And
talk a little bit about that because I know the Live Oak Express product is kind of different in the industry right now. Tell us just a little bit about that, and then we can talk about the larger
yeah,
acquisition
yeah.
facilities.
So it's been really good for if you have a small book that you're looking to purchase and you need $250,000, we can close within a couple of weeks, sometimes days. And so for those smaller transactions, they're great. We also do working capital through there. And I like where we sit because we see the sole advisor that has 40 million in assets under management. And then we also have these large facilities with, 20, $30 billion firms. So it feels like we get to see the whole industry. Um, but yeah, that express product is for working capital acquisitions, partner buyouts, really anything that an advisor might need. And it's just a faster underwrite, less requirements, and yeah, much
Less of a
faster.
headache.
That's right. Yeah. But so you were asking about you know, $1 million loan versus, $20 million loan. I think so we do lines of credit, we do term loans, and then, we put together more sophisticated credit facilities as well. So that's certainly a differentiator as far as like the different products. Um, and then for $1 million loan, we're going to look for like, tax returns and internally prepared financials. Um, and there won't be any covenants, fairly straightforward sort of term loan. As you start to move to a larger facility, the requirements start to get a little bit more, right? So you'll have financial covenants. You have to report quarterly. We'll require audited financials. Um, but I think the the coolest thing with some of these facilities is that we are helping these firms compete in a very competitive acquisition market. So you have, I mean, the number is probably, north of 70 national buyers right now. And so if you're more of a regional player or, aspiring to be a regional player and you want to compete in this market, one of the things that can help you compete is having access to capital and being able to move quickly. And so most of these facilities have a combination of three components. So there's typically a term loan that is usually like a refinance of your existing debt. Then you'll have a what's called a DDTL, which is basically like an acquisition or a growth facility. And it's set up where you have access to a certain dollar amount. So 5, 10, 15, $20 million. And that's what you'll use to draw on to recruit or to acquire. Um, and the customer will send in the information and say, I'm looking to, close on this deal. Here's the LOI. And we say, okay, great. Send us in the information. Once they send in the information, we'll close within 2 weeks. And so it really helps these firms stay, aggressive in the marketplace and, close quickly so they can compete. And the last component is typically like a line of credit. So we'll offer a line of credit for any sort of, business need that they might have.
That's great. And then DDTL is what is that? Delayed draw term loan, I believe.
Yeah,
Yes.
honestly, like the way that I talk about it is just like, we offer acquisition facilities or growth facilities. And then, once we, I really like to say that we meet customers and build products for the customer because that really is what we're doing. We take a look at, have a conversation with the customer. What are you looking to do? How much money are you looking for? What's your pipeline over the next 12 to 24 to 36 months? And, like, what's important to you? Is it, the amortization a problem? Is personal guarantees a problem? How can we craft something that meets your expectations, and then also our bank, our credit team can stomach?
Great. Now, to bring up a question that I think we all have a problem with is interest rates. How have you seen the fluctuations in interest rates over the past, let's say, 2 years affect um, Live Oak Bank's origination in the space?
Yeah, so I was at a conference, it was on a panel, and rates had just like skyrocketed, and the question was, do we think valuations are going to go down? And I think everybody said yes, and I said no. And the reason I'd say that is like I still feel that way today. Like I think people are saying that right now we're at peak valuations, and it feels like unless something really changes in the market, like a downturn that stays down, that's going to start impacting people's balance sheets and um, causing a lot of problems. I just don't see valuations going down because there's so many interested buyers. And so to answer your question, when rates went up, sharply, I do think there was a pause just to like understand what was going on. Um, but the appetite from the buyers was still there. And so I think acquisitions had a shorter pause. I think where it really caused issues is with the internal succession stuff. So if you're trying to buy 10% of a firm and you're a W-2 um, employee and you're relying on the distributions to cover your debt payments, well, the debt payments look a lot different when the interest rate was 5% and now it's 9%, and those are the deals that I think really had paused. And I do think we've seen more seller financing since rates have gone up. But generally, it's been very active. I mean, as you saw, last year was a record year. I think just based on how little sleep I get, I think that this year is going to be another big year.
And I guess multiples are definitely, as they increase, that makes the G2 advisor, it makes it much harder to cover their cash flow, their debt service coverage ratio. What are multiples looking like in the market from your end right now? And what do you think? I know you don't have a crystal ball, but what do you think those will be looking like in the next 6 months?
I mean, kind of, I think that multiples are like a really wide range. And I think, there's revenue multiples that I think are most applicable for smaller businesses. And it's really when you're buying a book of business, you're not necessarily taking over the staff. If there is staff, you're not taking over, the leasehold, the name, it's really just a list of clients. And so the revenue multiple there, makes the most sense. Um, and the one that's quoted right now the most, I'd say, is like 3.25. And we still see businesses trading below that on the smaller end. And we certainly see businesses trading higher than that on the higher end. And I think it's um, hard to determine like when to use an EBITDA multiple versus a revenue multiple. Before I answer this, I'm going to say, my advice is always to go out and get a valuation. This way, you're not just, using some arbitrary multiple and applying it to your business. There's lots of factors that go into valuations, organic growth, the succession plan, has it been executed, is G2 engaged, all those things. Um, but I think I've always said like once you get to like 1 million in EBITDA, then I think it probably makes sense to talk about an EBITDA multiple. And I'm not talking about a business that does 1.2 million in revenue and 1 million in EBITDA. That like it has more industry standard margins, which generally are like 40 to 60%. So, 2.5 million in revs, 1 million in EBITDA, sort of like where we're talking about. And I think on the low end, we still see like a 7x multiple on EBITDA, but I think that's, creeping up to more like 9. Um, Feels like everyone's trying to get to double digits. And we see double digits a good amount for businesses, probably a little bit bigger than that. And I think once you get to double digit EBITDA, now you're talking like real, big numbers, like with a two in front of it.
Right.
So I think the EBITDA multiples are as wide as, probably 7 to 24,
Yeah.
which
Well,
is kind of crazy. But I do think that that higher number is really for like well-established businesses and in a very large EBITDA number. And so hopefully I don't get a lot of phone calls with businesses looking for 20 plus EBITDA multiples, but
well, I'm sure you will. Uh, can we go back to kind of the more plain vanilla term loan that we're going to do? You have a guy with $100 million guy or gal with $100 million book who is going to call Live Oak Bank, and I guess the first thing you guys do would be collect information and then do a cash flow analysis. Um, when I was a lender, a lot of the time affordability was an issue, and the debt service coverage ratios were something that was kind of an art. It wasn't just some type of math problem you pull off of a finance textbook. Can you go through kind of how you view debt service coverage ratios and how that may affect the ability to purchase, the affordability aspect?
yeah, there's like a lot in that question. So first thing I say is like, back when I first started doing this, valuations were a lot lower. Like if there's anything that's changed the most in this industry, it's valuation. Um, and we were doing a lot of $100 million firm buying another $100 million firm. And it's harder today for that transaction to happen because the valuation has made it so expensive for that business that really what we've seen is that the buyers are larger and typically much larger than the seller. And so that's the first thing I would say is just based on valuation, it's hard for somebody to like double the size of their firm, with one transaction. Um, and then, the cash flow is, not really, rocket science, but I mean, we're taking the profitability of the buyer and the profitability of the seller and combining the two. And that's after the officer's comp. So we hear a lot of like EBOC being quoted, but we're looking at, earnings after the owner's been paid. And so that might be where some of the like nuances of how we look at it might be applied. We also will, take a look at the seller's business and, are there any changes going on with the acquisition? So is there any staff that's being replaced, or is there a leasehold that's being shut down? Certain things like that. And we'll come up with an adjusted profit or cash flow, and that's what we'll use to determine how much is there to be able to service the debt. And obviously, the debt is just the principal and interest payments annualized, and put that under the cash flow of the combined businesses. And for SBA, we require a 1.25 coverage. For conventional, we require a 1.5 coverage.
I think that's a really important thing for our clients looking to get financing to understand that. So thank you for that. So we had one question from one of our clients. We try to do that once a podcast. We have John M. in Houston. James, what are the best ways to plan for succession and get pre-approved for lending?
Yeah, so the pre-approved part's easy. So they can just call us. We actually have a form that they can fill out, and then we can pre-approve people for whether that's internal succession or acquisition. So that part's easy. The planning part, I think, is tough. I mean, still meet a lot of people that, they own 75% of the business and they only have 5 years left and they're trying to find a solution. And at today's valuations, it's really hard to transition that much equity in that short of a period of time. So I think the best advice I could give is to get started early and that's your best, avenue towards success. I think it's going to take, 15 years or so to transition the business. And so as soon as you get to a stage where, you have an employee, you probably should think about succession planning. And shortly after thinking about it, you should write a succession plan. And then shortly after doing that, you should execute on it. We see internal succession, actually selling some equity being done for a lot of reasons, but client talent protection or retention is a big one. And so, yeah, I mean, there's a lot of consultants out there that can help people with structuring it and making sure the paperwork's done correctly. So certainly reach out to those folks and have those conversations. But I would just say the earlier the better.
Yeah, that's good advice. Well, we're coming to the end of our time here. I just wanted to really thank you, James, for taking time to sit down with us at Finlink today. And we look forward to working with you going forward.
Yeah, anytime, Xander.
All right. Take care.
All right, bye.